Pfizer, a renowned pharmaceutical company, faced challenges in its financial performance in 2023 so far. The company's revenue declined significantly by 54%, indicating a sharp decrease in sales, and its net income also plummeted by 76.4% year over year, showing a substantial decline in profitability. Additionally, the stock price experienced a decline of around 31.2% year to date. Today we'll take a three-step approach to thoroughly evaluate Pfizer and determine its fair value. Step 1. Margin of safety. In this step we'll look at Pfizer's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here we'll delve into Pfizer's financial statements and assess critical metrics and ratios. In step 3 we will use a combination of valuation methods, such as discounted cash flow and discounted dividend, to gain an insight into the value of Pfizer's business. By using these methods, we can determine whether the stock is currently overvalued or undervalued in the current market on different metrics. In conclusion, by combining the findings from the three steps, we'll ultimately determine the fair value of Pfizer as an investment opportunity. To determine the final valuation, we'll be using a margin of safety. This margin of safety will be based on the financial health, the financial ratios, and the growth of the company. I'll be using a standard margin of safety of 25% that can never go below 0%. Margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green mean a 5% deduction. First metrics that we'll be looking at are the EBIT and margin growth. The EBIT has gone up over the years, gone from just over $17 billion in 2013 to just under $39 billion in 2022. During this period, the average growth rate in the EBIT was 21%, which is a 10% deduction from margin of safety. Margin has gone up over the years as well, going from just under 33% in 2013 to just under 39% in 2022. The average margin growth during this period is 4%, which is once again a 5% deduction from a margin of safety. The next two metrics that we'll be looking at are dividend growth and the payout ratio. The dividends have gone up over the years, going from 96 cents a share in 2013 to $1.64 a share in 2023. The average dividend growth during this period is 5.5%, which, looking at our scale, is no change in the margin of safety. This with the payout ratio that's sitting at 43%, which is once again no change in the margin of safety on this metric. The final two ratios that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. For Pfizer, this is just over a quarter, in this case a 28% debt to EBITDA ratio, which is a 5% deduction from margin of safety. The return on invested capital for Pfizer is sitting at a very high 18.4%, indicating that the management is very effective at allocating capital, awarding with yet another 5% deduction in the margin of safety. Looking very good for Pfizer so far. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Pfizer going from 2013 to 2022. The average growth rate in their free cash flow annually during this period has been sitting at just over 15%, but I'm projecting a free cash flow growth, actually a decline of 5% in their annual free cash flow for the next 10 years. With this percentage, we'll determine the future free cash flow for Pfizer and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This leaves us with a sum of free cash flow of $263.6 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of just over $250 billion. Dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $44.52, which is just over 27% upside from the current price. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of Pfizer going from 4 years ago to the current year. The average growth rate in the dividends during this period was sitting at 3.31%. I'm projecting all of their future dividends to grow by 3.5%, and we'll once again be using a discount rate of 8.5% in this valuation, giving us a dividend discount model price per share of $33.95, which is just over a 3% downside out of this model. The next model that we'll be using is Graham's revised valuation formula. In this model we take a look at the earnings per share that Pfizer is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that a PE of a company with no growth should never exceed 7. And looking at all of these metrics, we get a fair value of $34.70, meaning it's pretty much at fair value right now out of this model. And the last model that we'll be using is the mean reversion theory. In this model we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case I've imported the dividend yield of the past 5 years, and on average it has been sitting at 3.54%, while the current yield is sitting at 4.64%, indicating that it's currently undervalued in this metric. Doing the same with the PE ratio, on average it has been sitting at 10.52, while the current PE ratio is sitting at 6.91, once again indicating that it's undervalued on this metric, giving us a fair value of $49.58, which is almost a 42% upside from the current price. Let's go look at the final overview of a valuation next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, and the mean reversion theory price per share, giving us an average of $40.69. Our margin of safety we've determined earlier, using a standard margin of safety of 25%, deducting it by 5% for the debt to EBITDA, 10% for the EBIT growth, and 5% for the margin growth and return on invested capital, leaving us with no margin of safety at all, meaning that the fair value is the same as the average out of all of our models, which is the same $40.69. And with the current price that is just over $35, we get an upside of 16.18%, indicating that's currently a slight buy for our valuation. If you want to get access to all of the models that I use on my videos and much more, you can check in the description for my Patreon link. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.